This is held over slightly from the last session and focused initially at Alex, but I don't like other people's comments. We talk about the less developed countries from time to time and poorer countries, and we keep saying that they're not sufficiently involved in BEPS, we need something that's going to help them. And then we come up with a whole range of really complicated solutions which all the developed countries have got to agree to before we can do something to help the less developed countries. What happens if we look at it the other way around and say, actually, there's a fundamental problem in achieving the development goals that poor countries are not collecting enough tax? They don't all have natural resources. They don't all have residents and citizens who can pay the tax. They want to attract inward investments, so they can't tax that too highly. If we looked at it the other way around and focused first on what the less developed countries need, where might that lead us?
Alex,
thanks, Heather. Look, it's a good question, and one that's being asked a lot around the UN, as you can imagine. And there's this general sense that, given the numbers I mentioned earlier, it's entirely wrong that the OECD, rather than some UN body, should be the lead in setting international tax rules, and yet here we are, and that's where the expertise is to a great degree. But I think if you start from the other end, part of the problem is clarified by realizing that the evidence we have on the value of foreign direct investment into low-income countries in particular is that it is at best neutral for growth and may actually damage some human development outcomes. So, the investment that's going in is so bad, we probably don't want to focus on trying to attract that. But we recognize that longer term, you kind of need that capital. So you need to find a way of improving the quality of the investment as much as anything else, which is probably a different kind of question from the tax one. But I think what we're going to see, if there is a continuing failure to open up the international policy process, is greater attention being paid to national and regional, so East Africa community level alternatives. Now, for different reasons, but mainly because of the political pressure that comes on you if you raise the possibility that you might go away from the OECD rules, I don't think anyone will want to put their head above the parapet and do that. Brazil can do it, but Kenya can't. So what's left, I think, may be something like an alternative minimum tax based on formulary apportionment, where you say, look, we recognise we'll never have the transfer pricing capacity to respond properly to you and all your advisors, so we'll pretty much let you choose the prices that you want, and we'll nod them through. But if the amount of taxable profit that comes out is less than 70 or 80% of our formulary calculation, we're just going to draw a line there. So we will, on paper, continue to stick with the OECD, but in practice, we'll put a line somewhere else. And I think the revenue impact of doing that for most, certainly low income, but also lower middle income countries would be sufficiently dramatic that if somebody does it, it's going to create a rush to sign up to the same thing. And then I think we're into a different kind of dynamic, and that's, it's...
Alex, when you say formulary apportionment, are you talking about sales-based formulary apportionment?
No, sorry, I should specify. I think we're probably looking at either something like a Canadian formula, so payroll plus sales, or even a CCCTB with tangible assets in there too.
So you're asking for quite a sophisticated analysis of the proportion of sales and people and assets operating within that.
Sophisticated, although something you could do in a single spreadsheet if you had country-by-country reporting. So you're drawing a line that just says stick transfer pricing, as you wish, okay, but this is this far and no lower. I think.
Anybody else want to come in on this? I know I'm only chairing, but can I just come in anyway? So I'd largely agree with Alex, actually. I mean, I think the idea that, developing countries like Kenya or others should kind of take on the kind of full burden of what the OECD has just proposed is just ridiculous. I mean, it's just impossible for them to do that, I think. And I think that points in some much more simple tax base. I think we could argue about, exactly what it is. But, the idea... if you say, well, here's a kind of 450-page report on hybrid instruments, would you like to, implement that? The answer is, it's ridiculous that they should be expected to do that. So something has to be a lot simpler, because otherwise they're not going to collect anything.
Can I just say one thing about this? So earlier today, there was a big debate, I think, as I recall, between Stephen Edge and Paul Oosterhuis. But there was something of a debate about whether economic value was the product or the market, right? And people say, well, you have to link the tax to the economic value. And then we talk about, well, what do you mean by economic value? And of course, it's the intangibles, it's the tangible property, it's the payroll, it's the sales. And we can debate that for a very long time. The one thing that was consistent between the two proposals that were described today, the residual profit split and the DCT, we're calling it now?
Yeah.
Whatever you want to call it. I'm so used to hearing Michael and Alan say DBCFT, I can do it. And it is consistent, I might add, with where the U.S. states, who of course have had great experience with formulary apportionment, have all gone, is to overweight, in our case today, not 100%, because the residual profit split is an effort to take manufacturing and other payroll and other things into account to some extent, but to move in the direction of weighting very heavily the sales factor. And I think there are two reasons for that. One we've talked about a lot, which is the immobility of the consumer, and therefore the immobility of sales as a factor compared to the mobility of people and assets. The other, of course, is that when you do any of these formulas, you can't value the intangibles because they're out of the formula, and yet, as John Kay said, they're accounting for a huge amount of the economic rent. And so I think and so when Vanessa and Alex and others say, well, you really should think about formulary apportionment along with these other proposals, my inclination is to at least think about formulary apportionment with an overweighting, a substantial overweighting, I would say, of sales. And then you're getting pretty close in these proposals, one to another. They're not the same, and you're getting pretty close to the overweighting of sales that one might say a value-added tax implies, which is the link that Michael drew earlier during the day. So I just think we have to be clear when we say formulary apportionment. There are many formulas, and we ought to be clear about what we're thinking about.
Okay, thanks. Let's take another question, comment. Yeah, it's at the back here.
Well, I think if we get closer to sales, then we get further away from poorer countries getting any share in that tax base, just the same way that they do in the current situation. So I think that comes back to this problem, and I'll try again. So in the League of Nations 1923 report, the four economists said, the source country bears tax at source. Is that not true anymore? Because if it's not true anymore, then we can have a conversation about how poor countries can tax at source regardless of what rich countries do. But if it's still true, then it's not the case that poor countries will come up with some other form of tax in the space of unmitigated double taxation caused by a system that does not credit tax in the source country. So whether you do it as formulary apportionment, whether you do it as consumption or destination-based cash tax or what DCT, don't we have the exact same problem? And the problem is an allocation problem, which cannot be fixed in a tax and transfer scenario the way we're going to fix it domestically. The regressivity that we build in cannot be fixed if it's amongst countries, the way that we are proposing we would fix regressivity within countries. Just a question.
I still don't understand. Anybody want to answer?
I might just say that I agree. I mean, look, I think we're moving into a period when international conflict on this issue is much more likely. The failure of BEPS to address what, as Wolfgang said, is the biggest taxing rights distribution issue, and instead to focus on the conflict between tax havens and major OECD countries, is a failure that sets us up for conflict. I think between the potential for US-EU conflict due to a misapprehension that the EU is basically going after untaxed US multinationals, when in fact it's the US itself that's really losing most there on our analysis, with the fact that at some point I think somebody like China says enough of this, and you get a G77 shift, we move towards a point where you can imagine 10 years down the road, double taxation is actually much more likely to be occurring in multiple places, and only when we start shaking that out in the country-by-country reporting data will we start to say, right, this is where it is, and this is actually being unfair on companies in a fairly systematic way, and we need to get round a table, all of us, not just some of us, and start doing something about that. I think it's a pity that we didn't take the opportunity in BEPS to do that, and now I think it was probably only going to happen after that conflict.
Thanks. Wolfgang.
Thanks. I have a question following up on what John Kay has presented to us regarding return to risk and rents. We discussed risk to a certain extent in the group, but we had a larger discussion about rents. And when you look at it more closely, as you rightly say, there is a very clear-cut case for natural resources. You can have specific charges on those like mineral levies, etc., something with oil and timber and whatever. And then you have that large and rather fuzzy group of things like monopoly rents and agglomeration rents and innovation rents and all that. And as you rightly say, this contributes to a large extent to corporate profits. But on the other hand, it's very hard to nail down when you want to legislate in the tax area. And the option that has been used so far is to have the mainstream corporation tax work as a cover-it-all sort of tax. Do you have any clue as to how to solve this issue when you get the feeling that with the specific charges on the mineral stuff and natural resources, that seems to be too narrow, while on the other hand, the corporate income tax seems to be too broad to really address taxation of these rents in the countries where they are generated?
I mean, the way I see it is all this discussion is pointing us to is saying we want to have higher consumption taxes on the products of profitable companies. And really all the three things which we are, three schemes which we are discussing, achieve that end. That starts to drive me to say, well, maybe if that's where we're going, we ought to say that that's where we're going and just move on to doing it. And I'm tempted by the basic simplicity or the conceptual underlying simplicity of that. But it may be that some of the superficially more complex schemes we describe for moving in that direction are actually the best way of achieving that particular outcome.
Okay. Is that a question? Yeah, Judith.
Not again. I can see that point from an economic perspective, but from a public perception perspective, isn't that likely to generate the response that you should be taxing the companies, not the consumers?
The consumers are in a muddle on that, and will continue to be in a muddle. The consumers are rightly angry that Google and Starbucks are paying little or no corporation tax in the UK. The fact that it wouldn't, in fact, be a Mr. Google or Mr. Starbucks who paid the tax, which is the point that people have not yet grasped altogether. The point Rachel made earlier, that in the end taxes are paid by people, not by corporations. And the relevant issue is who these people are. That is key. But I think the popular perception is largely met by saying these profitable companies should pay more. And the extent to which that is paid by the consumers of these products, or which I think will largely be the case because we are taxing economic rents, I think it will largely in practice be paid by the shareholders of the companies concerned.
I just think that's quite a difficult selling job to the public. I mean, I can absolutely take the economic points, but I think, given where we're coming from, I think telling the public that the answer is to make what they would see them pay more for those goods is quite a difficult selling job, and that kind of comes back to the points that Vanessa was making.
Yeah, but if you call it formula apportionment, it doesn't look like that.
That's back to the point I made this morning.
Do you want to comment on that?
No, just I think Julia's making a really powerful point, and you know, how you present it is going to be really important to success.
Well, the politics in the U.S. are just worth making one observation about here. Ted Cruz, who finished second in the Republican contest, proposed a pure subtraction method value-added tax, including wages in the base, called it a business transfer tax, and I watched many interviews with him in the hopes that a journalist would inquire how it related to value-added taxes and press for an answer. I think was probably the only American disappointed that never occurred. And the House Republicans last week, this has been mentioned a couple of times, but it's worth mentioning again, have basically proposed something which is a bit of a hybrid, but it's very close to the DBCFT or whatever we're now calling it. And of course, their position to the American public is that it's a business tax. It's a tax on businesses. You know, if you do a subtraction method value-added tax instead of a credit method value-added tax, and you show that the business has just paid all this tax, and you call it something else, the likelihood that the average American, used to be known as the person formerly known not as Prince but as Joe Sixpack in the U.S., would understand it is virtually nil, and so I think that's what's happening, and I think that's true of formulary apportionment. I think it's true of the states moving to sales-based formulas and a whole series of other things. The problem is that public perceptions are extremely important politically, and public understanding is far less important politically. And I don't know how anybody, certainly won't be our group of six, can bridge that gap. We often look to the Financial Times for help on that, but there are not enough places to look, frankly.
Okay, thanks. We've got time for one more question. Well, yeah, Darren.
I think it is probably a myth to say the consumption tax is actually borne by the consumer, because at the end of the day, pricing is infinite. So actually a lot of businesses can only sell something at a finite price. And therefore, I know in particular, I have an experience myself, is that actually you have to bear some of the VAT because you cannot actually charge it to the consumer. Because when you sell something, you know the VAT has to go to the government, but actually you are not able to recover it in full, so you actually have to bear that cost. That's one.
I mean, that's fairly clear. A differential VAT on Starbucks will basically, the incidence of that will be on Starbucks.
And the other point was simply, I think, wouldn't the public rather have a tax system where they know that what you're going to charge is going to be collected rather than what's not? And isn't that more important for public finances at the end of the day?
Okay, can we keep that? I'm going to take one more point as well, question from Rita as well.
Hi, I was just going to say about this issue of the consumption taxes. And I think this is a real big question mark over all these assertions about incidence of consumption taxes, because we actually have no evidence that is the consumers that bear the cost of the consumption tax. There is very little thorough studies on the incidence of VAT, and the ones that exist have difficulties controlling prices in a meaningful manner. The European Commission tried in the early 2000s to do an experiment that lasted 3 years to try and assert the VAT incidence of labor-intensive services, and it encountered no medium-term effect on prices for decreasing VAT on a range of industries across a range of countries in the European Union.
Okay, thank you. Personally, I'd quite like to ban the term consumption tax because it seems to be used for quite a lot of different types of taxes, and they've probably all got different incidences. But would anybody else like to say something on consumption taxes, incidence? Vanessa, yeah.
Just not so much on the consumption tax point, but I think on the corporate tax point, you've got to be incredibly careful when you're presenting the alternative to it, to not be dragged into a problem on the question of incidence. I mean, as Mike said, academics really don't know that well what the incidence is. I remember Jim Hines saying it was a question that you'd like to ask God or something like that.
I said something like that.
And then obviously it's different from the US to the UK, but if you look at what the US sort of Joint Committee of Taxation or other luminaries say, they do say that shareholders pay a great deal of it. And so I think we could be in a very messy debate if people think that we're not saying that, well.
Okay, thank you. I think that's an invitation for more research, which is always the correct conclusion for many of these days. So I would say, as Vanessa said, I kind of presented the DCT to the Treasury Select Committee a couple of weeks ago. I had about 2 minutes before they kind of got a bit bored and thought it was all too complicated. So I would like to congratulate you on having been in here for 8 hours while we talked about these things. I'd like to thank the International Tax Group, all the speakers, the panel now, and all of you for taking part, and your reward is a drink outside in the hallway. So thank you very much. Thank you.